Today, higher mortgage delinquency is now officially a thing. Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. Today, the ANZ reported on their first half 2019 results. And one of the most interesting observations was the CEO's comment that mortgage delinquency rates are rising.
That cycle's an interesting one. I mean, look, the economy in Australia, and again, it's mostly about Australia in terms of the result at the moment, is in really good shape. Unemployment's low, interest rates are low, inflation is low. Things are not bad from that perspective. But there are a few little challenges out there. Wage growth, stubbornly low. Now, there's lots of theories about that, and I'm not the right person to talk about it, but that has an impact on our business. So we are a little bit worried about families out there doing it a little bit tough, and we see it in our own data. Now, at some level, the data's small. So we saw, kind of 500 or 600 families in this half get themselves into difficulty in terms of not being able to keep up with their mortgage payments. Now, for those 600, that's pretty horrendous, but that's out of about 1 million customers we have with a home loan. So we've got to put those things into perspective. But that's a lot higher than we've seen in the past. So the question for us is this a trend? Is it just a bit of a blip? Now, I think there's reasons to be optimistic. The economy is in good shape. We do have a good regulatory system. We do have good governance overall, and I'm confident that we'll kind of work our way through this. But that's the area that we're focused on most, in that homeowner area. I would say secondary would be there's a little bit of stress in some areas of small business, not across the board, not every industry, not every state, but there's some emerging signs of weakness there.
So today I want to discuss these results in some detail, but also draw out specifically the issues relating to mortgage delinquency and try and figure out what it all really means. Because, of course, I have for some time been calling out high mortgage stress, and that high mortgage stress would ultimately translate into higher levels of mortgage delinquency. So the ANZ had a strategy which I think I'll call shrink to greatness. In other words, they tried to sell parts of their business to home in on others. And to an extent, their strategy did work. But their results were flattered by a higher than expected institutional performance, which offset the pressure on the Australian retail bank from lower mortgage growth and margins and higher customer remediation costs. Now, ANZ are well capitalised, which is a good thing, given the higher and building mortgage delinquencies that they reported. They foresee tricky times ahead, though it's going to be tough to be a banker, I think. The results are also muddied by the many business exits and restatements and a significant reduction in staff. But among the big four, they are probably still the best placed, but they will be hit if mortgage delinquency continues to rise, as we suspect they will, as the Australian economy stalls. And ANZ announced a statutory profit after tax for the half year ended the 31st of March 2019 of $3.17 billion, which was down 5% on the prior comparable period. Cash profit for its continuing operations was $3.56 billion, up 2%. And the return on equity was 12%, compared with 11.9% in the first half of 2018, while the return on average assets fell 2 basis points from 0.79% in the first half of 2018 to 0.77% in the first half of 2019. Institutional delivered a higher than expected income, but that, of course, may not be sustainable, while other sectors were under more pressure. In fact, institutional profit was up 33%. Slower credit demand put pressure on the retail bank through lower volume growth and reduced fee income. And Australian revenue was down 6% as home loan repricing benefit was more than offset by higher funding, increased competition, discounts and regulatory changes. The net interest margin based on continuing operations dropped 2 basis points from the second half 2018 and was impacted by funding and asset mix, and customer remediation added 2 basis points, weirdly. Management said in their briefing that underlying net interest margin pressure will persist into the second half of 2019. ANZ's programme of asset sales and restructures benefited the business, and staff full-time equivalent fell 5% from 41,580 in the first half of 2018 to 39,359 in the first half of 2019. And costs were cut as a result, reducing the cost of running the bank by approximately $300 million, and they also absorbed around $550 million relating to inflation. However, the customer remediation program is now up to $926 million, or $657 million post-tax, since the first half of 2017. And $698 million is on balance sheet at the 31st of March 2019. And they say that they're currently resolving issues with more than 2.6 million customers across retail and the commercial businesses. The total provision charge for the half was $383 million, down 4% from this time last year, and the group loss rate decreased marginally to 13 basis points for the half from 14 basis points in the first half of 2018. New impaired assets declined to $890 million, which was down 8% compared to this time last year, with gross impaired assets broadly flat over the same period. And Australian gross impairments have risen from a low in March 2018, offset by lower provisions from institutional. Mortgage arrears in Australia rose quite significantly despite below-system mortgage growth by ANZ. In their briefing, ANZ said its Australian mortgage book will shrink further in the second half of 2019 because their strategies, which are aimed at improving momentum in this business, will take time to flow through. 30-day and 90-day delinquencies, missed payments, are rising, with property investors higher than owner-occupied borrowers. 90-day plus past due is at 100 basis points compared with 89 basis points prior, as well as the hike in 30-day past due. And Western Australian delinquencies comprise 30% of the total 90-day plus delinquency, despite being just 13% of the portfolio, and 65% of losses come from WA. Whereas New South Wales and the ACT makes up 32% of the portfolio, but 23% of 90-day plus past due. They also said the New South Wales dynamic loan-to-value ratio includes 8.2% of loans above 90%. But note, they say, valuations were updated to February 2019 where available. So this is understated in my view. The question is, what share of the portfolio is actually being marked to market? Given falling prices in New South Wales, more loans will drop into negative equity. And remember that this is loans, not households. Losses in Australian mortgage housing was 4 basis points in the first half of 2019, up from 2 basis points prior. And in the briefing, they attributed the rise in mortgage delinquencies to, first, the shift from interest only to principal and interest loans, demanding higher repayments, subdued wage growth, putting more financial pressure on households, the trends in falling house prices, a longer cure time frame, as delinquencies are now taking a lot longer to cure thanks to extended property sale timeframes, and the denominator effect of lower loan growth and a shrinking mortgage book. Of course, switching from interest only to principal interest will continue, as they showed in their data. ANZ's Common Equity Tier 1 capital ratio increased to 11.5%, up 45 basis points, and the return on equity increased 13 basis points to 12%, with cash earnings per share up 5% to 124.8 cents. The group's funding and liquidity position remains strong, with the liquidity coverage ratio at 137% and the net stable funding ratio at 115%. And the interim dividend is 80 cents per share, fully franked. And this equates to $2.27 billion to be paid to shareholders. The 3.7% reduction in shares due to the completion of the 3 billion buyback assisted. And the CEO said that retail banking Australia will remain under pressure for the foreseeable future, with subdued credit growth, intense competition and increased compliance costs impacting earnings. New Zealand, he said, is performing well. However, it is starting to share similar characteristics with the Australian market due to strong competition and a slowing Auckland housing market. But the major concern in New Zealand remains the impact of the proposed capital changes on the broader economy. And institutional banking is performing well and is positioned to provide positive earnings diversification, which will partially offset the headwinds in other parts of the group. So standing back, what we can see here is the outworking of that higher level of mortgage stress that I've been detecting for a couple of years, and we will continue to see mortgage delinquencies rising in the months and years ahead. Of course, the issue is now that the banks are beginning to wake up to these pressures on their books. So I expect to see higher levels of delinquency and default being reported, and more of the banks now starting to talk about the performance of their mortgage book. Some would say, better late than never. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll talk to you again next time.